As it was widely reported on Thursday of last week, the Canadian government and the Bank of Canada have renewed the Bank of Canada's mandate with some minor changes. And we're going to discuss what those changes are and what they mean to you after the intro. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back. As it was widely reported on Thursday of last week, the federal government and the Bank of Canada have renewed the Bank of Canada's mandate for a period of 5 years to continue to target 2% inflation with some modifications. And those modifications have some potential repercussions with respect to interest rates and interest rates staying lower for longer. I'm going to discuss what all that means, but before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. And today I am announcing, much like Chrystia Freeland and the governor of the Bank of Canada announced today, the renewed mandate, I'm going to announce my renewed mandate to get to 25,000 subscribers faster, but I'm going to throw in one little extra tidbit. We are just 450 subscribers away from being at 20,000 subscribers. I want to hit that by the end of the year. So if we hit 20,000 subscribers by December 31st of this year, we're going to do an interim draw for an additional $1,000. But in order to win it, you have to be subscribed. So go ahead, click that subscribe button. It's free, it's easy, and it's definitely worth it. And if you leave a comment in one of the posts between now and Christmas, you will have, between now and the new year, you will have an opportunity to win that extra $1,000. So go ahead, tell me what you like about my videos, what you think of the new mandate. Just leave a comment and you will be entered. So let's discuss what's happening with the new mandate for the Bank of Canada. As was widely expected, we are sticking to 2% inflation target with a 1 to 3% band or range that the Bank of Canada can and should operate in. Although there's been some minor changes with respect to employment and how they're looking at employment. Now, leading up to this announcement and into the fall of this year, when inflation wasn't quite expected to be going as long as it has, there was some talk about looking at different mandates, including one that paralleled what's going on in the US, where they have a dual mandate now that focuses on both inflation and employment. And what happens in the US right now is they're looking for the economy to be at full employment, and that allows them to let the economy run hot with inflation should there not be full employment in order to bring full employment up. Because what tends to happen is when you get into an economy where you have interest rates that are rising, you tend to slow down the economy. And if at the same time you are having a situation where there isn't full employment, well, if you start raising interest rates, you can actually have a negative impact on employment and a negative impact on the rest of the economy. Because what happens when you try to increase interest rates is what you're trying to do is you're trying to slow down the amount of consumption in the economy, which can have a negative effect on pretty much everything from inflation to the actual jobs and the type of work that's available. So the US has said officially that they're having a dual mandate. In Canada, it's not so official. However, it is now clear that jobs are a big portion of what the federal government and the Bank of Canada are looking for when they're looking at the Bank of Canada's mandate going forward. So I'm going to jump in here, take a look at the news as we tend to do, and I'll just show you sort of what's happening here with respect to the news articles. First and foremost, what the Bank of Canada's renewed mandate means for inflation and housing. Well, with respect to inflation, what it means and what most economists agree on is it doesn't mean a whole heck of a lot. The Bank of Canada was clearly taking a look at jobs when they were looking at the economy and when they were looking at interest rates. That so much hasn't changed, but what is clearer now is that they're going to communicate how jobs is impacting their decision making. And what this looks like or potentially looks like going forward is that there will be periods where it seems like inflation is running close to that 3% band or maybe a little bit higher. And what they will be doing is they will be looking at jobs at the same time and going, if we make a move on interest rates right now, if we raise them, what will be the likely outcome with respect to jobs? And if it looks like it's going to have a negative outcome, what that may mean is that they will let inflation run a little bit hotter for a little bit longer in order to make sure that jobs can be maintained. So that's the gist of it. They're just going to be really clear on the communication. And as the Liberal government does, and as I think Canadians in general tend to agree now, is if there is less jobs available, we want people to be able to work. We don't want to have this big separation in income gap and make it harder for those who are less fortunate or who have less income or who are on the lower bounds of the economy to be adversely affected by higher interest rates and therefore have basically people suffer as a result of trying to take care of inflation. So a little bit higher inflation seems to be something that the federal government and the Bank of Canada is willing to exchange in order to make sure people still have jobs, because obviously if you don't have a job, it makes it really hard to pay for things no matter what the price is. And a little bit of inflation, if you actually have a job, is better than having zero or low inflation and not having a job. So that's kind of where they're at there. One of the interesting things, I pulled up this global news article here, and one of the interesting things about it is at the bottom it talks about real estate. Obviously in the report that the federal government and the Bank of Canada put out with respect to their research on this, obviously any decisions made on this had significant amount of research. They talked about the housing market, and they talked about the Bank of Canada's role with respect to the housing market going forward. And the general rule of thumb here is that the federal government should be more responsible for housing. The provincial government, the municipal government should be more responsible for taking care of housing issues than the Bank of Canada, because obviously we're going to have lower rates for longer. The Bank of Canada has made that really clear. The Federal Reserve Bank in the US has made that really clear. And what that means is that when you have low interest rates, it encourages borrowing, and encouraging borrowing means you're going to have higher prices. And the only way to really deal with that is to make more supply available, because obviously lower rates, more money to be used to buy houses means higher demand. So what you have to do is you have to bring up supply to match that. And that is very much a government policy issue, not a monetary policy issue, at least as far as the Bank of Canada is concerned. And therefore, it is going to fall more on the federal governments and the provincial governments in order to take care of those housing issues. And that is very much, I think, prudent thought process when it comes to housing. What we need to be able to do is start building houses faster, get the bureaucracy and the red tape out of the way. I have a friend that we were talking to who's in the building industry. He was talking about the city of Calgary's municipal government being the anti-business department of the municipal government. So, what we really need to do is find a way for all three levels of government to not just get rid of the red tape when it comes to building more supply, but also to incentivize and make it possible for people to get into that industry. It's obviously a very tight-knit industry. It's hard to become a builder, but give some incentives and give some ability for there to be more competition in that industry so that more houses can get built, more properties can get built, higher density can happen. And as a result, there's more housing supply for people, which will ultimately have that negating effect on the lower interest rates and the higher demand. So that's kind of where we're at with respect to housing. Now, with respect to interest rates, here's the things. There's a little bit of talk in these articles about the fact that we're at low interest rates, and the Bank of Canada doesn't necessarily have the tools to go much lower with respect to interest rates. And what this means is I think they're expecting lower interest rates for longer periods of time. I think that's clear in their language and what they've talked about. And that's very much clear in the historical evidence that we have going back to the 1920s when Canada abandoned the gold standard. By the way, it was in the 1920s, not the 1970s, like one of our friendly YouTube counterparts has suggested. It happened in the US in the 1970s, but in Canada, we abandoned the gold standard in 1929. And we have pretty significant evidence that when interest rates are low, it takes a fairly long time for interest rates to gather enough speed to get up to, that 5, 10, 15%. And if you don't believe that for North America, you can take a look at Japan and look at what's happened there for the last 20 or 30 years. And pretty much any low interest rate environment in the last 100 years has had a pretty difficult time getting out of that low interest rate environment. And that's just purely because when you have low interest rates, as Benjamin Tal says, you have higher sensitivity with respect to interest rates, and therefore smaller changes have bigger results with respect to their impacts on the economy. So I think over the long term here, our recommendations with respect to variable still hold true. And what we do know about the financial cycles, about the recession and boom cycles, the bear and the bull cycles, is that they're happening faster today than they've ever happened in history. So while we expect that there's going to be interest rate increases and we're going to see things getting better, the stock market's better, employment's better, production's better, the overall output of the economy is better, we're probably likely in the next 3 to 5 years to see some sort of negative economic recession again. And as a result, we're going to see those interest rates go up and come back down and go up and come back back down, and we may see a steady rise over time, but we're going to have periods where interest rates go up and then they're going to come back down. And then depending on what's happening with employment and the economy, what it means is there's probably going to be lower interest rate periods for longer over time. And we're going to see that tendency for the Bank of Canada to sort of let inflation run in order to maintain jobs. So I think now more than ever, there's evidence that the variable rate strategy makes sense, aside from the fact that if you just run the numbers and you go, okay, on a $500,000 mortgage, it's going to cost me, $5,000 to $7,500 a year more to have a fixed rate than a variable. And then you just calculate it out and you say, okay, well, that's $300 to $700 in basically insurance I'm paying the bank in order to have a fixed rate. And then, oh, by the way, if I want out of that fixed rate, I'm going to have to pay a penalty. So I pay more for that as well. And I don't have the flexibility to make changes to my mortgage if I need to, or if I need to sell, I don't have the flexibility to sell because I have massive penalties. And you just look at all the things we've talked about in all the previous videos and the fact that we're going to have these extended periods of low interest rates as part of the mandate that the Bank of Canada has put into place. Well, I think it becomes really clear that that variable strategy, regardless of what happens in the next 3 to 6 months, is probably one that for the long term is going to be prudent for most borrowers. And if you're taking the difference between a fixed rate payment and a variable rate payment, and you're putting it aside every month and you're investing it and you're just keeping it so it's there for a rainy day, well, it's always better to have cash on hand than have a higher mortgage payment and be paying the bank the money and not have it set aside for you in case you need it. So again, my thoughts are really clear on this. I think variable over fixed is definitely something that has been, as long as I've been in the mortgage industry for 18 years now, something that has absolutely made sense, with the exception of a few periods of time where you could get a fixed rate mortgage for exactly the same price as a variable rate mortgage. And I think that will hold true for the next 5, 10, 15 years, especially for the next 5, as we know exactly now what the Bank of Canada and the federal government are thinking with respect to the importance of jobs in the Bank of Canada's monetary policy. So if you found this video useful, do me that favor, hit the subscribe button, hit the notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 20,000 subscribers. It's like 25,000 subscribers, but at 20,000 subscribers, we're going to make sure that somebody gets an extra $1,000 for those holidays. And we'll see you on the very next video. Cheers.